How to start trading futures. Futures trading is one of the most exciting opportunities in the financial markets today, and it's more accessible than ever. At its core, futures trading involves buying and selling standardized contracts that obligate the trader to purchase or deliver an asset at a predetermined price and date in the future. These assets can be anything from crude oil to coffee, stock indices to foreign currencies. A futures contract is an agreement between two parties to buy or sell an underlying asset at a set price on a future date. Unlike stocks, you don't necessarily have to own the asset. The goal for many traders is to profit from price changes between when the contract is bought and when it's sold or expires. Futures contracts are traded on regulated exchanges such as the Chicago Mercantile Exchange. Traders take positions by speculating on whether the price of the asset will rise or fall. If your prediction is correct, you profit; if not, you incur a loss. The key players in the futures market are speculators, traders aiming to profit from price movements; hedgers, businesses or investors protecting themselves from price volatility; arbitrageurs, those exploiting price differences between markets. With markets becoming more interconnected and volatility offering lucrative opportunities, futures trading has gained popularity among both retail and institutional investors. Some advantages over stocks and forex are: leverage, trade larger positions with less capital; diversification, access to commodities, currencies, and indices; liquidity, high trading volume ensures smoother entry and exit; extended hours, many futures markets trade nearly 24/7. Unlike stocks, where you buy and hold shares, or options, where you have the right but not the obligation to buy or sell, futures are binding contracts. You can make, or lose, money faster because of the leverage involved. While leverage can amplify profits, it can also magnify losses. Price volatility can be unpredictable, and without proper risk management, traders can lose more than their initial investment. The futures market is vast, and your first step should be picking a niche that matches your interest, knowledge, and risk tolerance. Commodity futures includes agricultural products, corn, soybeans, coffee, energy, crude oil, natural gas, and metals, gold, silver. Index futures track major stock indices like the S&P 500, NASDAQ, or Dow Jones. These are popular among traders looking to speculate on broader market movements. Currency futures allow speculation on the value of one currency against another, such as US dollar versus the euro or the Japanese yen versus the US dollar. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmenttees.com and use code BLOG to receive 25% off your next purchase. Before you place your first trade, you need the right infrastructure in place. Selecting a broker. Choose a broker that offers competitive commission rates, a reliable trading platform, and excellent customer support. Look for those regulated by recognized financial authorities. Account setup and margin requirements. Unlike stock accounts, futures accounts require margin deposits, which act as collateral. Your broker will set minimum margin requirements for each contract type. Trading platforms and tools. Modern futures platforms offer advanced charting, market news feeds, and automated order execution. Some popular platforms include NinjaTrader, MetaTrader, and thinkorswim. A successful futures trader must be able to interpret both technical and fundamental factors. Stay updated with Bloomberg, Reuters, or specialized futures news sources to understand what's moving your chosen market. Reports like the USDA crop report or OPEC meetings can move markets significantly. Knowing when they're released is crucial. Technical analysis. Basics involve studying price charts, patterns, and indicators like moving averages, relative strength index, and moving average convergence divergence to forecast potential market movements. Fundamental analysis in futures examines the underlying factors influencing an asset's price, such as economic data, weather reports, and geopolitical events. Many successful traders find combining technical and fundamental analysis methods advantageous because it gives them a comprehensive market view before making decisions. Here, we take a look at different futures trading strategies. Day trading futures focuses on short-term trades, entering and exiting positions within the same day to avoid overnight risk. Swing trading futures holds positions for several days or weeks, aiming to capture medium-term price swings. Hedging and long-term positions, used by investors and businesses to offset risk. For example, a farmer might sell wheat futures to lock in a price before harvest. Position sizing. Decide how much of your capital to risk on each trade, typically no more than 1 to 2% per position. Stop loss and take profit orders. Automate your exits to protect profits and limit losses. Trading plan. A clear, tested strategy helps you avoid emotional decisions during volatile markets. Winging it is a recipe for disaster in futures markets. Overleveraging. Using too much borrowed capital can quickly drain your account. Ignoring market news. Major announcements can cause sharp price moves. Always stay informed. Before trading with real money, beginners should use a demo account to simulate real market conditions. This allows you to test strategies, understand market volatility, and learn how to manage positions without risking actual capital. Track your demo trades in a trading journal, noting the reason for each trade, entry and exit points, and results. This habit helps identify what works and what doesn't before you trade live. Conclusion. Futures trading offers incredible opportunities, but it's not for the unprepared. With the right knowledge, tools, and risk management, you can navigate this fast-paced market confidently. Start small, stay disciplined, and treat it like a business, not a gamble. By understanding how the market works, selecting the right niche, using sound analysis, and managing risk effectively, you can position yourself for consistent profits. Futures trading is a skill, not a lottery ticket. Keep learning through books, courses, and market observation. Stick to your plan, and don't let emotions dictate trades. Stay disciplined, avoid emotional trading, and focus on long-term consistency instead of quick profits. With patience and dedication, futures trading can become a profitable and rewarding skill. Thanks for watching.